Imagine if your working capital, your cash reserves, your financial lifeline was Bitcoin. Not dollars sitting idle in a bank account, but Bitcoin, actively working for you on a global, permissionless financial network. At the same time, banks, yes, the very institutions Bitcoin was designed to disrupt, are now waking up to this reality. But it's not Bitcoin they're adopting first. It's stablecoins. And here's where it gets really interesting. Stablecoins might be the first true killer app of Web3 finance.
First, let's talk about Bitcoin as working capital. This idea was unthinkable just a few years ago. Bitcoin was viewed as volatile, speculative, a store of value if anything, not a medium of exchange for day-to-day business needs. But what do we see today? Companies are integrating Bitcoin into treasury management. MicroStrategy is borrowing against Bitcoin to buy more Bitcoin. Hedge funds are using Bitcoin-backed loans to unlock liquidity without selling their holdings. Bitcoin is no longer just sitting cold in a vault. It's moving, flowing, working. The narrative has shifted from passive holding to active deployment. This is critical because Bitcoin is not just another asset. It's a network. It's programmable money. You can move it at the speed of the internet. You can collateralize it without trusting a middleman. You can use it globally 24/7 without FX fees or clearing delays. It's a working capital solution for a global, digital-first economy.
Why are banks suddenly talking about stablecoins? Because stablecoins solve a major problem for them. The dollar as we know it, the fiat dollar, is outdated when it comes to global settlement. Wire transfers are slow. SWIFT is expensive. Cross-border settlement is full of friction. Stablecoins fix this. Hey, bring the dollar onto an always-on, programmable, permissionless network. A stablecoin works better than a regular dollar because it settles instantly, not in 3 business days. It's composable. You can plug it into DeFi, payment rails, remittance services. It's borderless. You don't need a correspondent bank in every country. Banks are realizing that if they don't offer stablecoins, someone else will. Whether it's Circle, Tether, or a decentralized protocol they can't control. That's why we're now seeing institutions like JP Morgan launching their own on-chain settlement layers like JPM Coin, and partnerships between major payment processors and stablecoin issuers. Here's the kicker. Stablecoins might be the app that sneaks Web3 into mainstream finance. Because think about it, stablecoins don't scare people. They're not volatile like Bitcoin or ETH. They're still dollars, but they're dollars with superpowers. Once you have stablecoins, what do you have next? Decentralized lending platforms to earn yield, on-chain payment systems that bypass Visa and MasterCard, tokenized treasuries and money markets, and all of that infrastructure is built on the same rails as Bitcoin and Ethereum. This is how the financial system transforms, not through a regulatory mandate, but through practical adoption of better technology. Stablecoins solve a real-world problem: faster, cheaper, global dollar settlement. And they do it in a way that forces banks, fintechs, and even governments to follow. Bitcoin and stablecoins are not rivals. They are 2 sides of the same financial transformation. Bitcoin is your store of value and your working capital reserve. It's your global hedge. Stablecoins are your medium of exchange, your payment rail, your operational liquidity. Together, they form a complete financial system that's faster, more open, and more resilient than what came before. And banks, for all their skepticism, are now building on these very same rails, because they can't afford to be left behind. The question now is not whether Bitcoin and stablecoins will disrupt finance. They already are. The question is, will banks adapt fast enough, or will they end up being service providers on a network they no longer control? Because whether your working capital is Bitcoin or your payroll is in stablecoins, the future of money is already on-chain, and that future is accelerating faster than anyone predicted.
Tether reportedly makes billions in annual net income. If you ranked it as a financial institution, it would be the third most profitable in the world, only behind giants like JP Morgan, Chase, and Industrial and Commercial Bank of China. And yet, it has no branches, no tellers, no legacy infrastructure. It prints money, literally digital dollars backed by short-term US Treasuries, earning yield while providing global dollar liquidity. That's a better business model than any traditional bank. This is why stablecoins are arguably the killer app of crypto, because they don't replace the dollar, they upgrade it. They turn the dollar into programmable money. They remove the friction from payments. They provide instant global settlement without intermediaries. And what's the anchor for this entire system? Bitcoin. Because Bitcoin was the first proof of concept. You don't need a stablecoin unless Bitcoin first showed the world that money could be digital, scarce, and borderless.
Bitcoin is the foundation. Stablecoins are the application layer. Even corporations are starting to figure this out. Walmart is exploring digital payment rails. Amazon has toyed with the idea of its own currency for years. Why? Because stablecoins offer something better than credit cards and bank wires. Instant settlement, lower fees, no reliance on third-party banks that take a cut of every transaction. If Walmart or Amazon issue a stablecoin, they not only improve payment efficiency, they create an entirely new revenue stream. They become their own financial services company. That's why the financial system is being rebuilt from the ground up, not by banks, but by tech companies and crypto-native firms. And remember, this all loops back to Bitcoin. Without Bitcoin, there's no reason to put money on the blockchain. Bitcoin proved that digital scarcity could exist without a central authority. It proved that a financial network could run without a government or a corporation backing it. Bitcoin is the foundation. Stablecoins are the application layer. Even corporations are starting to figure this out. Walmart is exploring digital payment rails. Amazon has toyed with the idea of its own currency for years. Why? Because stablecoins offer something better than credit cards and bank wires. Instant settlement, lower fees, no reliance on third-party banks that take a cut of every transaction. If Walmart or Amazon issue a stablecoin, they not only improve payment efficiency, they create an entirely new revenue stream. They become their own financial services company. That's why the financial system is being rebuilt from the ground up, not by banks, but by tech companies and crypto-native firms. And remember, this all loops back to Bitcoin. Without Bitcoin, there's no reason to put money on the blockchain. Bitcoin proved that digital scarcity could exist without a central authority. It proved that a financial network could run without a government or a corporation backing it.
And there you have it. The future of finance isn't coming, it's already here. Bitcoin anchors the system.
Stablecoins are powering it, and the old financial world is being forced to adapt or get left behind. If you found this video insightful, hit that like button, subscribe, and share your thoughts in the comments. What do you think? Will banks survive this shift, or are we witnessing the rise of a whole new financial order? Stay tuned, because this financial revolution is just getting started.